Okay, I'm going to continue. I'm going to continue where I left off. I was reading a book and I received a call, so I had no choice but to put an end to the YouTube live. But now I'm here back. Okay. Trading the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. Stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here they will sell issues they do not own or borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal, page 19 indicate, even small investors perish the term, sometimes try their unskilled hand their short selling. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings. Mm. Or for which some other favorable development is anticipated. Mm. Long-term selectivity. Here are the usual emphasis on excellent record of past growth, which is considered likely to continue in the future. In some cases, also the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. Such companies belong frequently in some technological area. Hmm. We've already expressed a negative view about investors' overall chance of success in these areas of activity. First, we have ruled out on both theoretical realistic grounds. We've already expressed a negative view about the investor's overall chance of success in these areas of activity. First, we have ruled out, on both theoretical and realistic grounds, from the domain of investment, the stock trading is not an operation, which, on a thorough analysis, offers safety of principle and a satisfactory return. More will be said on stock trading in a later chapter. In his endeavor to select the most promising stocks either for the near term or the longer future, the investor faces obstacles of two kinds. The first stemming from human fallibility, the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he's right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, already being carefully considered. Hence, the investor will select issues chiefly on the basis of this year's spur results or on what he is told he may expect for next year, is likely to find out that others have done the same thing for the same reason. In treating stocks with their long-term prospect, investors' handicaps are basically the same. The possibility of outright error and the prediction, which will illustrated by our analyzed examples on page 6, is no doubt greater than when dealing with near-term earnings, because the experts frequently go astray in such forecasts. It is theoretically possible for an investor to benefit greatly by making correct predictions when Wall Street as a whole is making incorrect ones. When Wall Street as a whole is making incorrect ones, but that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical, if disconcerting, conclusion: to enjoy reasonable chance for continued better than average results, investors must follow principal policies which are inherently sound and promising and not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes. And there are broad reasons to think that the answer should be affirmative and in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know implied terms when part of their anatomy from another. This book we shall point out numerous examples of discrepancies between price and value. Thus, it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, batting off others people's foolishness. So it seems, but somehow it doesn't work out this simply. Buying a net neglected, therefore undervalued issues for profit generally proves a protracted and a patient trying experience. Selling short too popular and therefore overvalued issues is apt to be a test not only of one's courage and stamina, but also of the depth of one's pocketbook. The principle is sound. A successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations which over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of over risk to those who knew their way around in this field. Um, they include inner security, arbitrages, payouts or workouts, and liquidations, protracted protected hatches of certain kinds. The most typical case is a projected merger or acquisition which offers a substantially higher value for certain shares than their price on the data of the announcement. The number of such deals increased greatly in recent years. It should have been a higher profitable period for the cognoscenti, but with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps too, the overall rate of profit was diminished by too much competition. Hmm. The lesson the profitability of these situations appears one manifestation of a kind of self-destructive process, akin to the law of diminishing returns, which is developed during the lifetime of this book. In 1949, we could present a study of stock market fluctuations over the preceding 75 years. We supported a formula based on earnings and current interest rates. For determining a level to buy the DGI below its central intrinsic value and to sell out above such value was an application of the governing maxim of the Rothschilds by cheap and sell dear, and it had the advantage of running directly counter to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they have gone up and sold because they have gone down. Alice after 1949, this formula no longer worked. A second illustration is provided by the formula famous Doe theory of stock market movements in a comparison of its indicated expanded resets for 897 to 1933 and much more questionable performance since 1934. A third and final example of the golden opportunities uh, not recently available. A good part of our own operations in Wall Street have been concentrated on purchase and bargain issues easily identified as such by the fact that were selling at less than their share in the net current assets alone, not counting the planned account and other assets. After deducting all liabilities ahead of the stock, it's clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned as a ridiculous low figure. Strangely enough, such anomalies were not hard to find. In 1957, Leach was published showing nearly 200 issues of this type available in the market. In various ways, practically all these bargain issues turned to be profitable. The average annual result proved much more remunerative than most other investments, but they too virtually disappeared from the stock market in the next decade. And with them, a dependable area for a shrewd and successful operation by the enterprising investor. However, at the low price of 1970, there again appeared a considerable number of such sub-working capital issues, and despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-size portfolio. The enterprising investor under today's conditions still has various possibilities of achieving better than average results. The usual list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. They should yield more fast results on the average than or the DGI or any similarly represented list. In our view, the search for those would not be worth the investor's effort unless he could hope to add, say, 5% of a taxes fee averaging any return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor. All of human unhappiness comes from one single thing, not knowing how to remain at rest in a room. Why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did? Because whenever you trade, they make money, whether you did or not. By speculating instead of investing, you lower your own odds of building wealth and raise someone else's. Graham's definition of investing could not be clearer. An investment operation is one which, upon true analysis, promises safety of principle and an adequate return. Note that investing according to Graham consists equally of these elements. You must thoroughly analyze a company, the soundness of its underlying business before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance. An investor calculates what a stock is worth based on the value of its business. The speculator gambles the stock will go up in the price because else will pay even more for it. As Graham once put it, investors judge the market price by established standards of value, while speculators base standards of value upon the market price. For a speculator, the incessant stream of stock quotes is like oxygen, called it often he dies. For an investor, what Graham called quotation of values matter much less. Graham urges you to invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Like casino gambling or betting on the horses, speculating in the market can be exciting or even rewarding, but it's the worst imaginable way to build your wealth. It's because Wall Street, like Las Vegas or the racetrack, has calibrated the odds so that the house always prevails. In the end, against everyone who tries to beat the house at its own speculated game. On the other hand, so long as you play only by the rules that put the odds equal in your favor, people who invest make money for themselves. People who speculate money make money for their brokers, and that in turn Is why Wall Street apparently downplays the durable virtues of investing and hypes the gaudy appeal of speculation and safe at high speed. Confuse speculation with investment. Graham warns is always a mistake. In the 1990s, the confusion led to mass destruction. Almost everyone, it seems, ran out of patience at once. America became the speculation nation, populated with traders who went shooting from stock to stock like grasshoppers, whizzing around in an always hayfield. People began believing that the test of an investment technique was simply whether it worked. If they beat the market over any period, no matter how dangerous or dumb their tactics, people boasted that they were right. The intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be substantially and reliably right. The techniques that became so trained in online day trading, ignoring diversification, flipping hot mutual funds, following stock picking systems seemed to work. But they had no chance of prevailing the wrong run because they failed to meet all three of Graham's criteria for investing. To see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65 miles per hour speed limit, I can drive the distance in 2 hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this in survival, am I right? Should you be tempted to try it too because you hear me bragging? It what flashy gimmicks for beating the market much the same. You short tricks so long as your luck holds it, they work. Over time, they will get you killed. Even the most respected money management firms got antsy. In early 1995, Jeffrey Vane, manager of Fidelity Magellan, had 42.5% of its assets in technology stocks. Vinnick proclaimed that most of its shareholders have invested in the funds for goals their ears away. I think their objectives are the same as mine. And they believe, as I do, that a long term approach is best. So much for the long term, and by 999, Fidelity's discount brokerage division was engaging on its clients to trade anywhere, anytime, using a Palm handheld computer, which was perfectly in tune with the firm's new slogan, "Every second counts." Wall Street made online trading sound like an interesting way to limit money. Discover's brokerage, the online arm of the venerable firm of Morgan Stanley, ran a TV commercial in which a scoffy tow truck driver picks up a prosperous looking executive. Okay, tonight this is it, and I'm back. I'm gonna come back tomorrow. Okay, bye bye.